you so much for staying with the program. Being a Tuesday, it's Biashara Tuesday, we're talking matters business. Today we want to talk about lending rates. Basically, in simple terms, it's interest rates. Like Kenny, my guest in studio, will be telling us more about why we are choosing to use lending rates today as opposed to using interest rates. That is George Munga, finance analyst as well as managing partner at AMG Consulting Group. We want to know what these lending rates are, how they work, what influences them rather, and what you should watch out for, whether you are a borrower or just following financial trends. We're watching Monica. So interact with us on our socials, TV47 Kenya on Facebook and on YouTube, on X at TV47 Digital. You can tag me as well at @Ann_Didi. And if you have any question for George here, there will be a number on your screen. You can call in live to ask your question. Karibu tena, George, to studio.
Thank you, Dida. Thank you very much. Thank you.
Let's start with the basics. Talk to us about the common terms, you know, that we should expect or we should know that you're going to come across when we're talking about interest rates and lending rates. And why are we using lending rates and not interest rates, George?
Thank you. Let me talk about interest rates versus lending rates. They're one of the same thing, two sides of the same coin.
Yeah.
But when you talk about interest rates, you are referring to cost of capital across the entire money market. You talk about interest rates in commercial banks. You also talk about interest rates in money lending companies or microfinance companies. You talk about interest rates in insurance companies. So interest rates generally is the cost of capital in the entire money market spectrum. When you talk about interest rates, lending rates. Now it is the interest rate for the lenders. For example, if KCB wants to lend to you, they'll call it either lending rates or interest rates. So it is one and the same thing, only that interest is more wider definition of the cost of capital. In the course of a program, we'll talk about MPC or Monetary Policy Committee. This is the committee that sits at the central bank and guides the commercial lending rates in the money market space. So it is the organ at central bank that guides the market on interest rates. We'll talk about also commercial banks, that is the banks other than central bank. You see, central bank is the mother of the commercial banks. Yeah. So commercial banks, the likes of KCB, Equity, Cooperative Bank, and all that. And then also talk about the central bank, which is the Banki Kuu ya Kenya, if I was to put it in Swahili. So those are the major terms that we'll be talking about as we go through this program.
Let's just start right there. You said we talk about CB, CBR, CBK. We hear about is it monetary margins? We hear about managing margins, base rates. Talk to us about them and how do they come into play when you're talking about lending rates?
When the central bank is guiding commercial banks on the lending rates or interest rates, there are factors they look into or parameters they consider. One of them initially, things have changed since 1st September, but initially they used to look at what we call the CBR. CBR is the lending rate that central bank would lend to commercial banks, and that is the base rate that a commercial bank is expected to lend to its customer. Now, a commercial bank would want to load something over and above that CBR that's provided by a central bank. For example, if the CBR rate for a quarter is say 12%, the commercial banks are allowed to add maybe 1 basis point, 2 basis points, or 3 basis points over and above that CBR rate to come up with the lending that they lend out to Nancy, they lend to Anne, they lend to George, they lend to company Y and company X. The premium that they load over and above the CBR previously now is dependent on the risk profile of the customer that they're lending to. That has changed since 1st of September. Now, instead of CBR, the central bank is talking about introduce something called Kesonia. That is Kenya interbank overnight lending rates. You see, commercial banks also lend to one another. Today, Bank X could be low on liquidity, and Bank Y has excess liquidity. So Bank X will lend from Bank Y overnight, meaning that money is lent today, tomorrow it is payable, and that capital, that money attracts interest. So central bank will look at the average overnight lending rate over a quarter and publish it, and expect commercial banks now to add their risk premium and their fees over and above that Kenya interbank overnight lending rate to come up with the interest rate that they lend now to earn to George, to XYZ enterprises. That is how it works currently. That took effect from 1st of September this year. Yes.
That is just this month.
Correct.
I want us to simplify this to our viewer, because it looks like we're using very, very big terms to use, and that is not nice. You mentioned something about Kesonia, that is the Kenya shilling overnight interbank average, and
Correct.
it says that it aims to bring more transparency and to get policy rate changes to reflect more directly what borrowers pay. Then how does it actually work in practice as compared to how the previous one used to work? That is the interbank. Is it the interbank?
The central bank lending rates to commercial banks,
yes.
the CBR.
So how does Kesonia now come into practice exactly?
The reason why central bank thought of replacing CBR with Kesonia is that CBR was more of a central bank parameter or a central bank rate that they were lending to commercial banks. So it was not reflective of what the market sentiments are at any given time. Remember, central bank is the lender of last resort. So if you're to go to them, you go to them when you have exhausted all avenues that you could get in the market. So it was not representative, or it was not a practical reflection of what the market sentiments are for that particular quarter. That is why central bank has gone back to Kesonia. Let me just simplify it. Commercial banks, the like of Equity, Corp, and all the rest, lend from or borrow from one another, lend to one another. And this lending is done overnight, meaning they take money from you today and they pay back tomorrow. And that money has a cost to it. So that cost is what central bank would collect for the whole quarter to come with what we call a Kenya shilling overnight interbank lending rate, or Kesonia for that matter. And once they publish that average rate for the quarter, then they now give commercial banks, they now allow commercial banks to load now a risk premium or a risk cost to that basis, plus now their fees. So for example, if now we are looking at the Kesonia currently is the average national overnight lending rates between June to August. Once that is published, then now you'll find commercial banks, say KCB, would loan maybe 1 basis point, 2 basis point, 3 basis point, even 4 basis points, plus now their fees to come up with your rate. The reason why this matters is because that is more reflective. It picks the market fundamentals out on any given date and then publishes it. So it is more practical as opposed to the CBR. Remember, commercial banks only go to central bank as the last option. Yeah. So bigger banks or tier 1 banks would rarely want to go to borrow from central bank. Tier 2 and Tier 3 banks would go. So that was not reflective of the market fundamentals for the quarter, as it were. And that is really the change.
All right. So in essence, we're trying to say that Kesonia, is it trying to benefit the banks, or is it trying to benefit the average mwananchi to make borrowing cheaper for the average Kenyan?
It has addressed two issues, Anne. One, it has brought more transparency into the market, because even you and today you can look at yesterday's overnight lending rates or the previous days of the previous day. So a keen borrower would be able to know what was the average Kesonia rates for yesterday or even for the last quarter. So that transparency. So I know that Kesonia for quarter 3 was XYZ percentage. My bank is charging me this. So meaning they have charged me maybe 2, 3, or 4 basis points over and above Kesonia. That benefits the customer in this way, that once I know that, then I can calculate my cost of capital even before I approach bank X, bank Y, and bank Z. You'll find bank X will load 1%, bank Y will load 2%, bank 3 will load 4%. So I'll go with the cheapest because I have that knowledge. So it has empowered the borrower to know what is the prevailing rate for that particular quarter. I'll give you an example, Anne. There's a client of mine who wanted to pick an asset finance yesterday. I think we were discussing yesterday, and you find I'll not mention the banks because that is now that's a bit personal. Yes. So you'll find Bank X was charging 17.5%. Another bank was charging 16%, and then another one was charging 15%. And then there's a processing fee. There's a bank that was not charging processing fees for that particular facility. Another bank was charging 1%. Another bank was charging 1.5%. But now the difference again is that the bank that was charging highest was giving 100% financing, and the bank was charging lowest was giving 90% financing. So it gives the borrower leverage to know where does he fit. He fits best. In a sense, what it has done to the borrower is that when you've gone to, say, Mudhurwa Market, you have a variety of groceries that you want to compare notes with. So you'll go to Mama X, Mama Y, and say, how much are you charging for your groceries? And they'll tell you, and then you'll pick what fits best to you. Yes.
So you do agree that with Kesonia, it comes into play and it's profitable, it's predictable, and brings a lot of fairness in regards to borrowing, lending, and interest rates.
Correct. That is what it has. Addressed in the market.
All right. Let's go back. What influences lending rates? Let's start there. I know that inflation comes to play. The CBP, the central bank policy comes to play.
Yes.
Then what exactly determines lending rates in the country? And then we're going to look at it from the global perspective as well.
Lending rate, as I said, is the cost of capital in a given jurisdiction, and it is influenced by largely 4 or 5 factors. The number one factor that influences lending rates is the inflation rate in that particular country. If you find inflation rates at, say, 5%, then you'll find most commercial banks will not charge anything below 5%. Otherwise, they'll be losing money to inflation. So that is number one. Number two is exchange rate of the currency vis-a-vis the harder currencies. Like, for example, banks will look at the exchange rate between Kenya shillings for Kenya and US dollar, Kenya shilling versus the GBP and all that, because remember, you must convert your currency to harder currency before you're able to import. So exchange rates matters a lot when it comes to determining the lending rates. Number three that I know most people don't want to hear, but the other factor that will influence the interest, especially in a country like Kenya, are the interest rates in capital markets like the US money market. So the USD rate that is determined by the Fed feeds into eventually the interest rates that Kenya shilling is charged on. Remember, all central banks across the world maintains an account with the Fed, the Federal Reserve Bank in the US, because of international trade. So the interest that is charged on the USD in the US eventually affects the interest rate that we pay as Kenya. And of course, the other closer home is the cost of treasury bills and treasury bonds. Why does it matter? You see, the government is the biggest borrower in the market. So the rate that they borrow from the market are the TB rates for the shorter term securities, and the treasury bonds or the treasury bonds rates for the longer term securities. Remember, let me just explain that further. When government borrows from the market, then they don't go to the market. They don't go to a commercial bank and tell them, give us 1 billion, 2 billion, 3 billion. The way they do, they structure their lending into what we call securities. So they'll offer a paper in the market that says, if you give me 1 billion shillings, then I'll give you this piece of paper that is redeemable at the end of, say, 3 months or 1 year or 15 years. So for the shorter term, that is between 1 year, between 3 months to 1 year, are treasury bills. The longer term that goes for 5, 10, or 15 years are treasury bonds. So that rate that now the banks or the money market lends now to the commercial, I mean to the government, are the TB rates, treasury bill rates, or treasury bonds rate. So commercial banks would want to look at the treasury bills rate or treasury bonds rate at any given market for them to know how much now do they lend to the private sector. If the treasury bills rate, that is the most commonly used, is say 9% or 10%, then they'll want now to maybe add another 3 or 4% to that rate before they arrive at the rate that they lend now to Arnold or to George. So that is very important. So those are the factors that commercial banks look at, or central bank looks at, before they determine the interest rate at any given time.
All right. We're talking about inflation and CBK among others. So inflation rates of inflation pressures and CBK policies can affect this lending rate. So how are our lending rates in the country currently? Currently, are they profitable in any way to, let's say, our investors, our economy, and myself as a borrower? Our lending rates, how they are currently in the country?
Kenya has one of the most matured money markets in the continent, and you must give it to our commercial banks. I think our commercial banks are the biggest counters that you can trade in East Africa. That I'm talking about now, the quoted commercial banks. That includes Cooperative Bank, Equity Bank, Kenya Commercial Bank, NCBA. Those are big. Those are big names. So the way they price their loans in the market determines how the market responds or how the economy grows. We have kind of experienced a stifled credit growth, especially the private sector, because recently commercial banks have not been lending as much to the private sector as they've been doing to the government. The reason is the central government's appetite for lending has been so high that most commercial banks will find it commercially viable to lend more to the central government as opposed to the private sector. That is why you've seen there's a bit of plateauing in the credit growth to the private sector. So if commercial banks can lend more to the private sector, then you see a lot of GDP growth or growth in GDP in the country year on year, as opposed to when they lend to government. Most monies that go to government apparently go to recurrent expenditure, not to development. That is why you've seen those shifts in the market over the period.
Now, the CBR was recently cut to around 9.5%, but we've also seen concerns that Kenyans are not seeing the benefits of this. They're saying that the proportional drop has not been felt yet by a couple of Kenyans. Then why is the case? If the CBR has been cut to 9.5, then why is there so much delay in the implementation of what the CBR is saying? The
CBR has went down to 9.5. Of course, from this quarter now we'll be talking about the Kesonia rate. Yeah. But the decrease in the CBR, it has not reflected or was translated into more credit to private sector. You see, there are two different aspects to it, and there is the interest rate, and then there is the availability of liquidity to the private sector. So the interest rates went down, yes, but that capital has not flown to the private sector. That's what I was trying to explain earlier. Yeah. That a commercial bank, a treasurer at a commercial bank would sit down and see if I can lend. You see, any money that are taken to government are considered risk-free because government is considered cannot default on their facilities. That is now debatable because remember the other time I think Ghana defaulted on their sovereign bonds. So that is now debatable. But as it were, for a long time, or even to date in Kenya, let me talk about Kenya. Any lendings that goes to government are considered risk-free. So any treasurer in a commercial bank looking at capital allocation, for example, if they have say 5 billion and they want to see do they lend it to the private sector or do they lend it to government, in most cases they'd want to go to government, even if the differential is say 1, 2 or 3%. Why? Because the cost of managing lending to government is cheaper. The reason is I'll push 1 billion, 2 billion, 3 billion shillings to government and just wait for maturity of my security, and then I go and redeem that money back. If I lend to say Anne or George, then I must continuously monitor what Anne is doing, what George is doing. Did he apply this money to what he had said he's going to apply? Is the repayment coming back as expected? So those are the things that commercial banks will. That's why whenever the appetite of government is high in the money market, then most commercial banks would want to push money to the central government as opposed to the private sector. So the interest rates might come down, but how does the capital flow to private sector now? How does those figures look? Are commercial banks willing to lend to the private sector? Remember, and in this country, there's a time that government had very little appetite for local borrowing, and therefore commercial banks had to push this money out to private sector. That's why you would get bank officers coming to knock on your door to try and sell a facility to you. Remember, anytime money sits in the coffers of a commercial bank, it is a cost to them because they have to pay interest on those facilities. So the moment that money comes in, they must channel it out. The easiest way to place it is through government. Government has that appetite. And the second is now private sector. The moment government has a huge appetite for borrowing locally, then you'll find capital flowing to the private sector is quite minimal. And that's what has happened locally.
All right. Now you're talking about commercial banks feeling secure to lend to, the government as opposed to lending to George or lending to Anne. Then what do we need to do to bridge that gap? If, commercial banks are feeling safe with the government and not to lend to me, then what do I need to work on to ensure that even if I approach a particular bank that I need, say, 10 million loan. I don't know if that is possible, George, you correct me if I'm wrong. But now what do I need to do to ensure that I'm aligned with the bank's rules and how they want, the payment to be done, to ensure that even as much as, they don't want to lend to me, they're feeling safer with the government, that I can also get that grace to get that loan.
I'll talk about the macro element in it, and then the micro. The macro element is what you and me cannot control, and that might only be controlled by the government. Sometimes to a certain extent, not even the government, the local government might not be able to control it. For example, if I wanted to go and borrow from Kenya Commercial Bank, the interest rate is out of my control because that is the central bank that determines together with the commercial bank, that is KCB at that particular time. Availability of that facility or availability of that capital to me also is out of my control, because then again that is controlled by central government. If central government doesn't borrow much from commercial banks, that capital now is available to me. If they don't, then if they borrow a lot from the local market, then that money is not available to me. So those are the macro aspects, things that are not within your control. Let me come now to the micro aspect, things that are within your control. There's a masterclass that I attended that we used to say initially. We used to say that the reason why I cannot do business with lack of capital. I was correct and told capital has never lacked. It is only ideas that lack in the market. Capital is always there, and capital always chases ideas. So the way you package your product, or the way you package your business plan is what matters to a commercial bank. Is there a business case for whatever it is that you want to do? How are your past records looking like? Do they support a future plan that is clearer to a third party that can see that is if I put my money here, I will get it back? And even if you had to give me money, I've told you I have a business I want to go into, and I want you to lend me, say, 10,000 shillings. You'll query me what I'm going to do with your money. If I cannot explain what I'm going to do with your money clearly, then it's unlikely that you'll give me that money. But if I'm very clear in my mind what I want to do, and this is the roadmap that I want to follow, then you can easily give me that money. That is what commercial banks do. When you go to a commercial bank and you put your case very clearly, and they can clearly see, even from your historical records, that you can be able to follow through with your plan, then they'll give you the capital that you need. You've had stories from business people who have been successful, that instead of them going to look for banks to lend them money, it is the banks that look for them to give them capital. Why? Because these people have seen you have a clear roadmap, you have what it takes, you're aligned with the market, so what you need is just capital to move you from point A to point B. And in most cases, especially in Kenya, when somebody goes to a commercial bank to borrow, they still don't know what they want to do with that money. They want just to borrow for the sake of borrowing. I'll give an example of those who go to borrow personal loans. You've been told that you can qualify for 1 million shillings, you can qualify for 2 million shillings. Because you qualify doesn't mean you need to go and borrow. You need to know that whatever I'm going to borrow, I'm going to apply it A, B, C, and D, so that money can pay itself back. You need to get a facility and invest in such a way that from that lending, you can be able to pay that facility back. But if you don't know what you're going to do with that money, then that loan can easily go bad, and you might not be able to pay.
So if you're taking a loan from a bank, you have to have an investment in store. What I'm getting from you is, for example, I'm taking this loan and I want to, say, build a house with it or get a car with it. Is that the right way to do it, or must an investment be something on the table first?
You can take a loan for consumption, Anne. It is allowed. Though not the best option, but it is allowed.
How will that?
For example, you might take a loan to buy yourself a car. Sometimes it's good to feel good, Anne. Where you come from, they say you live once, so it is okay. But it is not a very good way to apply a facility, or to apply money that you have borrowed. Remember, when you borrow for consumption, that loan, the moment you borrow it, it becomes a cost to you, because you must be able to finance that lending. You must be able to be repaying the monthly installments, but also whatever you bought for consumption, you must be able to finance it. For example, if I took a facility and bought a car, I must be able to repay that loan. That is number one. That's a cost to me. And I must also be able to finance this car, because it will need fuel, it will need repairs, it will need all those costs that go with it. So I have two costs in one. So what do I look at if I was to do that? Do I have a stream of income that can be able to finance these two together? The cost of this facility, the monthly payments, and also cost of maintenance. So that is one thing that you must look at. The second thing that you must check, for example, if I was borrowing to buy a house, buying a house is a very good idea, and because one, if you borrow to buy a house, it is not a consumption borrowing per se, because initially you have to live anyway, is it? You have to live somewhere. So instead of paying rent, I've decided now I'm going to pay, say, a mortgage, is it? So you've just transferred that cost from rent now to to mortgage. And remember also, houses or property, as it were, appreciates in value after certain given after a given period of time. So you don't lose value per se. So after some time, you find that maybe if that house was 10 million, now it is 12, 13, or 14, or 14 million. So there's that distinction that you must that you have to make between borrowing for consumption. What kind of consumption item are you buying, and borrowing for a serious asset like a house? Yes.
I'd love for you to clarify something there on mortgages, because I've been to a business class once, and they're saying, you know, if you're paying a mortgage, then it becomes more expensive as opposed to if you're just paying rent. They're saying, you know, if you're doing mortgage, then you're losing a lot of money as opposed to, you know, if you were to pay, say, 15,000 on rent per month, then kindly clarify on that. Is it that expensive to pay for mortgage, or is it something that you would recommend for more use?
It is debatable, Anne, and I must tell you that maybe I'll be biased on this, because my first house I bought on mortgage. So if I'm biased, your viewers will forgive me for that. But I think borrowing for a property is a good idea. One, it assists you to accumulate capital. Remember, when you start now, I'll address those who are employed. If you're employed, you have two options. Either you go out there and look for a rental property and you rent, or you go and pick a mortgage and pay the mortgage. In most cases, Anne, you'll find the amount that would have spent on rent is slightly lower, or even substantially lower than the amount that you'll spend on the mortgage. Remember, mortgages are long term. That is why at the end of the mortgage period, you find you've paid almost double what you had borrowed. Let me start with the cons of that. The cons of that is, one, you pay more back to the commercial bank than what you had borrowed initially. Number two, the cost of your installment, that is the principal plus interest, normally in most cases will be higher than your monthly rent. If you're to pay rent if you pay rent for your accommodation. Those are the two cons. Now let me come to the pros. If you took a mortgage, say by the age of 25, I think that's the time I took my mortgage. I told you I'll be a bit biased on this. By the time you're 35, it's most likely that you have redeemed that mortgage. So number one, it's a form of forced saving, because when you pick a mortgage, you must pay the installment. By the time you are closing, or the time you are clearing that mortgage, you have a valuable asset that you can pledge for a facility. If you took a mortgage, say for 6 or 7 million when you are 25, by the time you're 35, that property will be valued at almost 15, 16, or even 17 million. And you can use that asset to go and borrow from a commercial bank to start a very serious business. A business that is 10, 20, or 10, 12, 13, 14 million is quite a serious business. And in our country, if you're told to save 10 million, even for a period of 10 years, it's normally not very easy, especially because of our society. Remember, our society is in such a way that if you have money in your bank account, there's always reasons to spend it. Not even for your comfort alone, but you'll find there's a problem back at home. You need to send money. There's something that has happened here. You need to, and if you have money, normally as human beings, you'll want to spare that money and go and assist in those areas. But if you're paying mortgage, that money is not available to you in the first place, so you cannot spend it. So at the end of the year, at the end of the period, there's that saving that you've accumulated back into your finances, and you can use it now to jumpstart something that is serious. So anybody who wants to take a mortgage, personally, I would advise that you go for that mortgage.
But it's a debatable topic.
It's debatable. I said it's debatable.
All right.
Yes.
You know, I've seen concerns about sometimes you given a loan, and then the interest at the lending rate that you took it at, it keeps on growing. Unapata, if you were to pay it at around 15,000 Kenya shillings back, now it keeps on growing. Unapata imefika 17,000 Kenya shillings. Then what determines that growth of an interest rate?
It goes back to two things. Number one, the commercial banks are very cunning when it comes to this, especially for long-term loans. They'll give you a rate, say 15%, but they talk about a floating rate, meaning that rate is subject to change depending on the CBR rate
they
initially.
Let you know that.
Yes, they put it. They'll not mention to you verbally, but in your letter that you're signing, they'll put that in the fine print that these rates are subject to change depending on the CBR rate or the Kosonia rates for our time now. But the commercial banks that will give you a fixed rate, meaning if they told you 17%, it's 17% for the entire period. So that is something that you need to ask your commercial bank before you sign that offer letter. That is this rate you're giving me floating or fixed? If it is floating, what are the margins? How far can it go? How far can it go up or how can it come down? Normally, there's two sides to this coin. If you're given a fixed rate, say at 17%, then you'll not benefit from any reduction in the CBR or in the Kosonia rate in the market at any given time, meaning you are stuck with the 17% throughout the tenure of your loan. If you're given a floating rate, then if rates come down, then you likely benefit from the lower rates. Or if rates go up, then you must absorb the cost. So it is you to decide what do you want to pick from the market. Do you want a fixed rate or a floating rate? For our market, Anne, I would advise anybody going to a commercial bank to borrow to get a floating rate, because our money markets have been stable for quite some time now. So if you take, say, a loan at say 15%, then maybe if it's a floating rate, it might go up by 1% or even go down by 1%. So if it was floating rate, then if CBR was to come, if Kosonia was to come down, then you'll benefit from that lower interest rate.
Talk to us about the effectiveness of monetary policy in the country, because sometimes we've seen this central bank, calling on commercial banks to, bring down those interest rates. But sometimes, banks don't comply or just lag or delay in implementation of this. Is it legally binding for these commercial banks now to not, be in line with the monetary policy? Because if the CB says reduce the interest rates and there's no compliance, then, or direct implementation, then is it legally binding for these banks?
It is legally binding, but remember the MPC will give a CBR rate previously or the Kosonia rate currently, and then they give banks leeway to apply what they call risk premium and their fees, which they cannot determine. They cannot tell a bank that you must apply a risk premium of say 1%, 2%, 3%, or 4%. So they'll give what we call a base lending rate of say 12%. So Bank A, Bank B, Bank C are allowed to apply now their risk premium to that. And even Bank A might decide to apply 3% for customer X, 4% for customer Y, and even 5% for customer Z. So what is binding between central bank and the commercial banks is the base lending rate. Anything above that, what we call the risk premium, is subject to the risk profiling of that particular commercial bank. But again, I must give it to central bank that they try and rein in on the commercial banks that they supervise. Remember, banks must publish or must inform central bank of their fees almost every quarter, that this quarter we're going to charge fees of XYZ for this facility. So in that space, they try as much as possible to rein in on commercial bank. That is why currently you will find the rates that commercial banks charge across the market are they almost mirror one another. If there are any differentials, they'll find differentials of maybe 1%, 2%, or maximum of 3%, as opposed to previously, Anne, where you'll find a bank charging 15%, another bank charging 24%, another bank charging 30%. That has quite stabilized currently because of what MPC is doing, and by extension what central bank is doing. if you go to the more informal lending market, then you'll find, especially the mobile lenders, you'll find the charge as high as 60% or even 70%. That tells you that commercial banks are now more regulated by central bank as opposed to the other money lenders in the market.
And when you're talking about mobile lending apps and these banks, then we're trying to say that the lending rates are better than this mobile lending apps?
Definitely. They're much better. Mobile lending apps, and I don't know if you've taken one, they charge their interests per month, not per annum. So you'll find they'll charge you 2% per month. That is 48% that's 24% per annum, is it?
Yes.
They charge you, some charges as high as 5% per month or even 10% per month. You see, 5% per month is 60% per annum. 10% per month is 120% per annum. That is the differential. But again, why do they charge that? That is the question that you must ask yourself, because they're giving you an unsecured facility. And normally, the moment you apply for that loan on you get that loan almost free. So they're picking a very huge risk in the market that they must be compensated for. The reason why they charge that high is because if they lend to 10 people, 5 people are likely to default and 5 people are likely to pay. So the 5 who pay must pay for the other 5 who default. That is how they do their risk profiling.
It's the risk of non-payment from borrowers.
Yes, correct.
I was seeing an argument on Twitter the other day, and it was about the CBK's prioritizing growth through rate cuts. And the question was, is this risking pushing inflation up in any way, if the CBK is now prioritizing growth using rate cuts?
The advantage that CBK has is that it has a lot of intelligence from the money market. So the moment you see CBK pushing for rate cuts, either they want to the commercial banks to push more credit to the private sector to augment our GDP growth. And remember, CBK monitors these parameters almost on a month-on-month basis. So this month they might advise commercial banks to reduce the lending rates, and then they look at that effect on our inflation rates for that particular month. If they realize that our the inflation rate is getting high, then they'll advise for an increase and mop up more credit from the market. So CBK has the advantage of having several tools and a lot of intelligence from the market to be able to manage that. So I would not be worried if CBK was to advise commercials to reduce the lending rates and therefore push more credit into the market. They have those intelligence, they have those tools that they can be able to manage inflation. And I can tell you, Anne, that Kenya is one of the countries that have the least inflation rates in Africa. Our inflation rarely passes 5%, and we must give it to the central bank.
We are doing amazing.
Correct.
All right. So how much of the average, that is 15% lending rate, right, is made up of hidden costs? Say fees, talk about insurance, we have penalties as well. With this 15%, if it's the average lending rate, then how much do we have in this, hidden costs?
Hidden costs now are bank to bank. And let me demystify this, Anne.
Yes.
They're normally not hidden. The challenge with us as a country is that we don't like reading a lot. Yes, that's the challenge that we have. I've worked in commercial banks. And you find most of these costs are in the paper you are told to sign. And normally they tell you that before you sign, go to a lawyer so that he can interpret for you. So they'll tell you in that offer letter that we're going to charge A for this, for insurance, we're going to charge you this, our processing fees is this, our annual review fee is this. So they'll give you all that in your offer letter. And can I tell you, Anne, you can go back to your lender and tell them that I'm agreeable to this, but I'm not agreeable to this. Can we talk about this? And they'll listen to you. The challenge we have is, one, we don't want to read, and then number two, most Kenyans, when they have gotten that offer letter, they're just targeting now the money without looking at the cost of that capital per se. So I'll rush very fast. Normally, most people would want to tell you, tell me where to sign. They put their signature. The money is loaded. They only realize that this loan is attracting a lot of costs once they start paying the loan, or once they have paid the first year, the second year, the third year. Still the balance of the loan is XY. That's why the cost of this money was this high. Those costs vary from bank to bank, and that is given, that's allowed, that central bank allows them to do that. The only thing they're not allowed is not to put that in your offer letter. So when a customer or when a borrower gets an offer letter, go through it. If you cannot go through it, go to a consultant or a lawyer to just interpret to you what is the cost of this, what is the cost of this capital, what is the implication of this capital to you as a business or as an individual.
Let's talk about SMEs for a bit. You know, there has been complaints among the small and medium enterprises that financial access is quite a challenge for them. And you've mentioned something about capital should not be a problem with somebody starting up a business. But if you're looking at the lending rate, say, which is at 15%, is it in any way choking the ability to expand? Because if they're talking about financial access being a challenge for them, then we're working with, say, a 15% lending rate, or so it's at 15%, right? That is where it's capped at. Then is it in any way choking the abilities of so many SMEs in the country? They're the backbone of the economy, to expand.
I think cost of capital has not been a challenge to SMEs in the market, Anne, for a long time.
Really?
Because for the last decade, let me put it that way, you'll find our cost of capital, especially for SMEs, ranges between 17%, between 14 to 17%, which most SMEs can absorb. The biggest challenge for SMEs has been securitization, meaning what do I use to secure this this facility? That has been the biggest challenge in the market.
Still
because let me just explain that. An SME would want to get a 10 million facility, and you can clearly see that the business plan is very good. You can be able to pay that facility. The only place that commercial banks have failed is to be able to collateralize cash flows as opposed to tangible security. Most commercial, in fact, I can say all commercial banks, let me say, not say all, most commercial banks would want to get a tangible security for any facility that they are giving you. And in most cases, they'd want to get property to be able to secure your facility. Most SMEs don't have access to that security. And that is why you find SMEs cannot access lending easily from commercial banks. The reason why the government can access financing easily from the market is because there's nothing they offer in return. What they give you is a paper to hold that they owe you XYZ amount of money. How do corporates do it? Let me tell you how corporates do it, Anne. A corporate would do what we call a bond. It used to be popular sometimes bank, but I think with the collapse of Chase Bank, with the collapse of Nakumatt, then the bonds have become a bit unpopular. But that is an avenue that corporates use to be able to get money from the market, meaning they just print IOU notes and give Anne, give George, give Ben, give so-and-so, and you give them that money without security, with a promise that they'll pay you back that money after a given period of time. If we can allow SMEs to also structure something to that in that line, then I think SMEs will not complain of lack of capital in the market. How do other markets do it? Other bigger markets. Let me give you a reference to China. China, the government guarantees any loans that goes to SMEs, meaning an SME will give you a note, an IOU note, that when you give me this money, then I'll repay it back in after, say, 10 years, is it? But in case I don't pay you, then you can present this paper to the government, and the government will be able to pay you. So personally, the way I think we can flip that is instead of government lending to people the way we've done the Hustler Fund, we did the Women Enterprise Fund, we did the Youth Enterprise Fund, government should put a guarantee fund somewhere that the guarantee IOUs that SMEs would go to commercial banks with, so that I can walk into KCB without a security, but with a business plan, and the KCB will be able to give me that money. But in case I don't pay that money, then the government is obligated to pay back KCB. That way, most SMEs will be able to access more capital from the commercial bank. As I told you, capital has never been a problem. In fact, banks look for avenues to invest their money. The only challenge they have is, if I invest this money in ARN, will I get that money back? Remember, the money that commercial banks hold are normally not their money. They're holding monies on behalf of their customers, and therefore they have a fiduciary responsibility not to lose that money.
So for SMEs, the money is there, but the issue now is securitization.
Correct. That is the problem.
All right. As we come to the tail end of this conversation, George, for our viewer now, what do we need to watch out for as a borrower, as far as lending rates are concerned?
Lending rates are coming down, and I know not significantly, but we've had, I think, over the last 3 years, we've had lending that went up to all the way up to 18-19%. They came to 17%. Currently, we are between 15 and 16%, and even corporates are getting as low as 12%. So lending rates are coming down. I expect them to stabilize between 14 and 15% for SMEs. I'm seeing most commercial banks wanting to lend more to SMEs or to the private sector. The only challenge is the market. The market has dried up. Meaning there are not so many investment opportunities that commercial banks would want to lend to. My challenge to SMEs or my thought to SMEs is that if you're an SME operating in Kenya, you need to look at markets beyond Kenya. You need to look at East Africa now. You need to look at the broader East and Central Africa for opportunities to grow your business. As I was saying, our market has kind of dried now. If you talk to most SMEs, their business models are no longer sustainable if they're just relying on the Kenyan market alone. So they need to look at markets beyond our borders to grow their business. And as I was telling you, Anne, and I'll repeat, capital is there.
Capital is there, securitization is the problem.
Correct.
All right, that is George Munga. Thank you so much for making time for us to have this conversation. We're talking about lending rates this morning, more or less interest rates, if you want to call it that way. George Munga is the managing partner at AMG Consulting Group, as well as a finance analyst. Thank you so much for watching. You're watching Morning Cafe. My name is Anne Odida. Stay with us.